Gold has just collapsed below $4,000 an ounce. In a matter of months, the historic price gains of 2026 have been entirely erased, and silver is violently plummeting right alongside it. Look at the broader picture, and the global economy seems highly unstable. We are dealing with severe geopolitical tensions in the Middle East, persistent inflation, and a ballooning U.S. Treasury debt that threatens the long-term creditworthiness of the dollar. If the global financial system is effectively on fire, why is the ultimate financial fire insurance currently crashing? The answer comes down to intent. There is a massive difference between holding an asset to protect your purchasing power over decades and buying it simply because the price went up yesterday to ride short-term speculative momentum. When investors confuse long-term asset insurance with a short-term speculative lottery ticket, they guarantee that they will panic and sell at the exact wrong time. Think of a safe haven asset like an umbrella. When it rains, an umbrella is incredibly useful, but if everyone on the street panics and buys one at the exact same second, the price shoots up artificially. Eventually, those panic buyers decide they'd rather have the cash, so they start dumping their umbrellas. The price drops, but not because the umbrella is broken. This chart shows historical gold ETF inflows, revealing a massive, disproportionate spike in 2025. Financial market funds poured over 800 tons of hot money into what we call the currency devaluation trade, chasing a solid long-term thesis with highly volatile short-term capital. Prices aren't determined by millions of quiet long-term believers. They're dictated by a tiny fraction of impatient traders desperate to transact today, the marginal sellers. When gold's momentum paused, these leveraged speculators rushed for the exit all at once, triggering a rapid price collapse. This plunging price is a direct reflection of how vulnerable those impatient speculators are. It does not indicate a failure of the asset's underlying utility. The exact catalyst that killed that upward momentum came from the Federal Reserve. By holding interest rates steady between 3.5 and 3.75%, the Fed signaled they will not surrender easily to inflation. Because gold yields exactly 0% interest, higher rates mean holding cash or bonds becomes much more attractive. The opportunity cost of holding gold simply gets too high for short-term traders. In moments of sudden market stress, institutional funds and households both need immediate cash to pay rent, service debts, and meet margin calls. You cannot pay your mortgage tomorrow with a gold bar. This creates a counterintuitive reality. In the early stages of a true liquidity crunch, a severe shortage of available cash, gold acts like an ATM. Investors sell their highly liquid, most profitable assets to raise emergency funds before they attempt to sell their worst assets. We are seeing this ATM effect at the highest levels. Central banks and nations facing acute domestic financial pressures are currently liquidating portions of their gold reserves strictly because they need immediate cash. Silver acts as a massive magnifying glass for this sentiment. Because silver is both a precious metal and a vital industrial component, its even sharper crash shows that the market is unwinding multiple speculative narratives simultaneously, fearing both a cash shortage and a global economic slowdown. The crash is happening because the immediate short-term fear of a cash shortage is temporarily overriding the long-term fear of currency devaluation. Yet, if you look past the retail panic, institutional patience remains intact. Global central banks remained net buyers in the first quarter of 2026, accumulating over 240 tons of gold right through the dip. This global capital reshuffling creates distinct regional pressures, especially in open markets like Hong Kong. Because the local currency is pegged to the US dollar, elevated American interest rates directly squeeze local liquidity and heavily pressure local yield-bearing assets. But this exact type of macro panic creates an extraordinary hidden opportunity. When markets frantically sell off to raise cash, outstanding companies with low debt and highly stable cash flows get dragged down, pushing their valuations to highly attractive, historic lows. You cannot buy blindly into the red, though. You must know how to separate a structurally weak company from a strong business that has been unfairly punished, and you must know how to calculate its true margin of safety. To help you navigate this specific market landscape, we at Stewardship Finance Academy have designed a free stock investment masterclass to teach you how to evaluate the real businesses hiding behind market panic. Click the link right down in the video description below to secure your free spot before we close registrations. Real wealth is not built by jumping from one speculative momentum trade to another. It is built by establishing a disciplined framework where you understand the exact purpose of every single asset in your portfolio.